What's going on, guys, and welcome back to another video. If you're new to my channel, then welcome. My name is Jason, and on this channel you'll find videos on personal finance, investing, and money related topics. So if that's something that you're interested in, be sure to hit the subscribe button down below and join the family. In today's video, I'll be going over a TFSA versus a RRSP. By the end of the video, you should have a good idea what a TFSA is and what an RRSP is. And if you're excited for today's video, be sure to smash the like button, as it does help with the YouTube algorithm and it does help support the channel as well. And with that being said, let's jump right into my computer and go over these two accounts. So before we get started, let's take a look at what a TFSA account is. So back in 2009, the Canadian government introduced the TFSA accounts. And this was a way to encourage people to save money. And since you already pay tax on the money that you put into your TFSA, you won't have to pay any tax when you withdraw any of the money. And a cool thing about TFSAs is that they have very few withdrawal rules associated with them. And you're actually free to withdraw at any time without a penalty. But of course, there are some government mandate limits to how much money you can contribute every single year. And the amount of money that you can put into the TFSA each year is known as your contribution limit. And that varies from year to year. So let's say you make positive gains from any of the investments that you hold within a TFSA. Those are actually considered tax-free. And within a TFSA, you can actually hold any type of investment, such as ETFs, GICs, stocks, bonds, and so on. And if you take a look at the TFSA contribution limits table here, you can see here, since it started back in 2009, the yearly contribution limit has stayed at $5,000 per year. But in 2013, they did increase it by $500 to $5,500. And in 2015, they actually increased it to $10,000, and that was the only year that they did that. Because right after that, they brought it back down to $5,500. And since 2019, they have actually increased it another $500, making it $6,000. And another thing to note is that in order to open up a TFSA, you must be 18 years or older. So looking at the TFSA annual limit chart again, let's say in 2009, you were 18 years old and you have not touched or put any money into your TFSA. So let's say you're 25 years old currently and you never contribute to your TFSA and you finally want to start doing that, you can contribute a total of $48,500. If you're 26 years old, you can do $53,500 and so on. And just a quick warning, if you do over contribute to a TFSA, you'll be penalized 1% per month on the over contribution. And if you want to find out your current TFSA limit, there's two ways that you can find out. The first way is what I call is the easy way, and it's simple. You just keep track of every time you invest money into it. And the second way that you can look at it is just going straight to CRA's My Account, and you can just check it out there. Keep in mind that's not always accurate, as they are delayed by a couple of, I think, months or so. So keep that in mind before you go ahead and put money into your TFSA. And one of the cool things about a TFSA is that, let's say for example, you withdrew like $40,000. The following calendar year, you'll be able to put in that $40,000 again, plus whatever the additional contribution limit is. For example, for 2020, it will be $6,000. And one thing to keep in mind is if you're holding US stocks and you're getting US dividends, the TFSA is subject to a 15% withholding tax. But you only really see a huge difference of that 15% if you're holding a ton of money in your TFSA. And if that's the case, it's kind of better to just hold any of the US dividend paying companies in an RRSP. So when it comes to knowing when you should actually use a TFSA account, that will obviously depend on your income level, what you think you'll be earning in the future, your spending habits, your savings goals, and so on. If you're just getting started with a TFSA account, it would be a better option for you, obviously income wise, because if your income is less than $50,000 a year, it will be more beneficial to you to use a TFSA account. And also, if you'll be needing your money within the next couple of years, you want that money to have no restrictions when you need access to it. So moving on to the RRSP, if you've never heard of this, you're probably wondering what the heck even this is. So a RRSP is a government-sponsored retirement plan with a significant tax benefit to it. And it does work a bit different than your normal TFSA. With an RRSP, you get what's called a tax advantage account, meaning that the RRSP accounts are specifically provided for tax break purposes. And any money that you contribute to the RRSP within the current year, it will actually be exempt from income taxes the year that you make the deposit. But you will only get taxed, for example, when you retire years down the road. And just like a TFSA, RRSPs also have contribution limits, in which these contribution limits are also calculated annually. And the way to calculate your RRSP contribution limit for the year is to deduct 18% of your income, or for 2020, which is $27,230, or whichever is less. And the type of investments that you can hold in an RRSP is identical to a TFSA account as well. And the amount that you decide to put into your RRSP every year, the recommended is that you should always max out whatever the total amount is. But because with the RRSP, you can't always withdraw the money at any time like a TFSA, you need to make a realistic budget for yourself on how much you can actually put towards an RRSP. Typically, you want to keep about 3 to 6 months of living expenses in your emergency fund, just in case, because you know you cannot withdraw your money from the RRSP. If you decide to withdraw money on RRSP ahead of time, it will result in a heavy penalty. And let's say you've maxed out your RRSP and you have more money to put in, you're better off putting the remainder of the money into a TFSA and letting that grow tax-free. And like I mentioned when I was talking about the TFSA, if you want to invest heavily in foreign stocks, particularly the US stocks, it's highly recommended that you put that into your RRSP, because the IRS in the US does not recognize the TFSA as a retirement account. Now, it is recommended, but you really don't have to. If you're considered in a lower tax bracket, you're better off using a TFSA over an RRSP. And the reason being, obviously with the RRSP, you get the tax benefits. Because the higher amount that you make, it'll make more sense to use an RRSP for those tax breaks. And if you're a student or you're just getting started in your investment journey, then most likely you won't have a lot of savings. And in this case, a TFSA would better be appealing for you. Because as a student or a new investor, you want to have access to your money at any time, and with the TFSA, you can withdraw it tax-free at any given time. And if you're wondering if you can move money from your TFSA or to your RRSP or vice versa, the answer to that is yes and no. So let me explain. Yes, you can move money from your TFSA to your RRSP. In order to move any of your investments from your TFSA into your RRSP, you actually have to liquidate your current assets of however much that you want to move over to your RRSP. And obviously transferring from RRSP to a TFSA would not really make any sense. And just like that, guys, I hope you enjoyed today's video. And if you learned something, be sure to smash that like button. And also, if you haven't already, be sure to hit the subscribe button down below so you don't miss out on future content just like this. And with that being said, I will see you guys on the next video.